There is a silent transfer of wealth happening in America right now, and almost every single middle-class family is on the losing end of it. Every Friday, millions of hardworking people deposit their paychecks into traditional brick-and-mortar mega banks. You check your mobile banking balance, see that your money is safe from market crashes, and take comfort in knowing that your emergency fund is there when you need it. But what you are not told is that the banking system is quietly using your loyalty against you. While you sleep, the largest banks in the country take your deposits and deploy them into treasuries, prime loans, and high-yield commercial credit, generating massive interest margins. And in return for lending them your hard-earned life energy, they hand you back an annual interest rate averaging around 0.38% according to the FDIC. On a $20,000 emergency reserve, that is $76 a year. Meanwhile, true inflation quietly chips away at the purchasing power of that same cash. You are not holding cash. You are holding a depreciating asset that is being quietly drained of its real economic value. But there is another side to modern banking that Wall Street rarely advertises to the everyday saver: the high-yield savings account, or HYSA. Today, we are tearing open the mechanics of how online banking architecture actually functions, why these accounts can pay 10 to 12 times the national average without risking your principal, and how you can reclaim thousands of dollars in compound interest that is rightfully yours. If you believe that your money should work just as hard as you do, take a second right now to subscribe to the channel. We break down the real, unvarnished financial blueprints every single week so you can keep the wealth you build. Let's protect your financial foundation together. To understand why this matters on a human level, let's step back and examine how we got here. For generations, opening a bank account meant walking into a marble-columned building on Main Street, shaking hands with a local branch manager, and receiving a physical paper passbook. In that era, physical infrastructure was everything. Banks needed real estate on every street corner, vault security systems, and hundreds of tellers and loan officers to process daily transactions. Those physical branches cost billions of dollars to build, staff, and maintain. Guess who paid for those marble columns and branch managers? You did. Traditional banks subsidized their massive overhead by paying depositors near zero interest on their cash. But in the modern digital era, a new breed of financial institutions emerged. Online banks eliminated 80 to 90% of physical overhead. No physical teller lines, no expensive corporate leaseholds on every suburban corner. Instead of pocketing those massive structural savings as corporate profit, digital banking platforms pass those operational efficiencies directly back to you in the form of a higher annual percentage yield. They take the benchmark rate set by the Federal Reserve and return the vast majority of that yield straight into your account balance every single month. But whenever people hear about 4.5, or 5% interest rates on liquid cash, a wave of skepticism immediately kicks in. Is this a gimmick? Is there hidden risk? Are these online banks just tech startups ready to vanish with your life savings during the next economic panic? Let's clear this up with absolute clarity. A legitimate high-yield savings account carries the exact same federal safety net as the biggest commercial bank in the world. When you deposit money into an FDIC-insured institution, your capital is legally backed by the full faith and credit of the United States government up to $250,000 per depositor, per insured bank, for each account ownership category. If the bank literally ceases to exist tomorrow, the Federal Deposit Insurance Corporation steps in to make you whole up to that legal limit. Risk does not come from the technology platform. Risk comes from leaving your money unprotected against economic erosion. Let's look at the mathematical reality of what this looks like over a decade of your working life. Imagine you maintain a conservative $25,000 emergency reserve, money earmarked for sudden medical bills, home repairs, or potential job loss. In a traditional bank paying the national average of 0.38%, that $25,000 earns approximately $95 in its first year. Over 10 years, with basic interest compounding, your total interest earned is less than $1,000. Now, place that exact same $25,000 into a high-yield savings account compounding monthly at 4.5% APY. In year one alone, your money generates $1,125 in pure, hands-off passive cash flow. Over 10 years, without you ever depositing an extra dollar of your own paycheck, that account balance grows to over $38,800. That is nearly $14,000 of clean, risk-free compound interest paid directly into your pocket. That $14,000 difference is not just an abstract number on a spreadsheet. That is 4 months of mortgage payments. That is an entire replacement HVAC system when yours breaks down in the dead of winter. That is the difference between sliding into high-interest credit card debt during a family crisis or walking through an emergency with complete emotional peace of mind. But this brings us to the psychological trap that prevents millions of people from ever making the switch: financial inertia. Megabanks know that human beings are creatures of habit. Behavioral finance research consistently shows that the average consumer keeps their primary checking and savings accounts at the exact same bank for over 16 years. Banks rely on the friction of opening a new account to keep you stuck in a zero-interest holding pattern. They count on you being too tired after a long workday to spend 10 minutes filling out an online form. Let's break down how you should structure your banking ecosystem to maximize every single dollar while maintaining zero daily stress. You do not need to abandon your everyday checking account if you love the convenience of local ATMs or branch deposits. Instead, you build a simple, automated financial hub. Step 1. Keep your primary checking account strictly for transaction liquidity. Maintain 1 to 2 months of essential living expenses here, just enough to cover your rent or mortgage, utility bills, groceries, and a modest safety buffer of a few $100s. This keeps your cash flow moving smoothly without risking overdraft fees. Step 2. Open a dedicated high-yield savings account at an established, FDIC-insured institution. Link this new savings account directly to your primary checking account via standard automated clearinghouse, or ACH, transfers. Step 3. Route your true emergency fund, typically 3 to 6 months of non-discretionary living expenses, into this high-yield account. If you are saving for specific short-term goals over the next 1 to 3 years, such as a house down payment, a car replacement, or a wedding, create designated savings sub-buckets within that same high-yield account. Step 4. Automate your monthly contributions. Set up an automatic recurring transfer on the day your paycheck lands. When your savings happen automatically in the background, you never experience the emotional pain of manually transferring money away from your daily spending balance. What about accessing your money when a true crisis hits? Modern high-yield accounts offer rapid electronic transfers that settle within 1 to 2 business days. Furthermore, many modern accounts now offer integrated debit cards, check-writing privileges, or instant transfers to linked brokerage accounts. While the Federal Reserve eliminated the strict mandatory 6 withdrawal limit under Regulation D, keeping your core emergency fund in a separate online account provides an invaluable psychological barrier. It prevents you from impulsively tapping your life savings for weekend splurges. At the end of the day, building financial freedom is not about timing the stock market or chasing high-risk speculative trends. It is about closing the structural leaks in your daily financial foundation. Every single dollar you earn represents a piece of your finite time on this earth. Leaving that money to decay in a low-interest account is a quiet tax on your hard work. Take 10 minutes today to audit your bank statements. Check your exact APY. If your bank is paying you pennies while charging you for the privilege of holding your money, it is time to take your capital back. Move your emergency fund to where it is valued, protected, and actively growing. How much interest is your current savings account earning you right now? Have you already made the move to a high-yield account, or what is holding you back? Drop your thoughts and questions in the comments below, and let's keep building our financial independence together.